Okay, so now I formally welcome all of you. Very good afternoon to all of you from CA Gaurav Garg. Today we're going to discuss Intergroup services from transfer pricing perspective. It's 5:01 in my watch, and it's a good time to start the discussion. First of all, how many of you are actually dealing in transfer pricing issues? If you can share the same in a chat box, that would be of great help. How many of you are actually dealing in transfer pricing? Am I audible? I haven't received any response, so I'm not sure whether I'm audible or not. Thank you, Ravi. Thank you, Ayushi. If you can let me know how many of you are actually dealing with transfer pricing issues, maybe as a consultant or maybe working in some with some client, in some company and looking after transfer pricing matters. Great. So we have one answer from Alokik. So Alokik is in transfer pricing. Thanks, Ravi. Any other friend, any other participant who is working on transfer pricing issues? So we have someone who is involved in doing transfer pricing on regular basis. Okay. And if you can also text your country or state from which country you are participating. We got more than 200 registration from different countries. Approximately, I think from 12 countries we got the registration. So different tax professionals from different countries shown their interest in this online discussion on transfer pricing. So why I choose? So we have friends from UAE, and UAE recently would going to have transfer pricing law starting to 2023. We're going to see transfer pricing in UAE. So we have friends from Pakistan also. So why I choose today's topic, intra-group services, TP is a vast field, and I personally feel transfer pricing is a very interesting subject, and all the more doing transfer pricing documentation or litigation for intra-group services is again very interesting within the transfer pricing ambit. See, you cannot, as far as goods are concerned, they generally cross the border. So you have physical goods in your hand, to showcase to the tax authorities. But what about services? So service is is one of the form of intangible. You cannot touch. You are receiving services, maybe on a regularly basis, maybe on a one-time basis, and sometimes it's become pretty tough to document the service transactions. Sometimes documentation is easy, but sometimes documentation is tough, and all the more we have benefit test in transfer pricing as far as services are concerned. It makes things more interesting, that how to justify the benefit or how to satisfy the benefit test. All this makes me very inclined, this makes me very focused on doing the transfer pricing work specifically for intra-group services. So I thought, let me take up a topic, and it's a transfer pricing season in India. The friends who have joined from India, they know that we have transfer pricing deadline of 31st October to meet, and most of the transfer pricing consultant, I think they are busy in doing transfer pricing compliance year or annual transfer pricing compliance. So we're going to have good discussion. I also circulated one email wherein I asked that if you have any question with regard to intragroup services, you may please share with me. I got few replies, but unluckily they were not on intragroup services. They were on other aspect of transfer pricing. So I would restrict myself to answer question on intragroup services today. So the format would be, I will start my presentation, and if you have any question, you may please feel free to raise your hand, and I would be try my best to revert to your question. Kindly be clear on the facts. If you have some facts in mind, kindly be clear while sharing that fact, and be clear on your question, and I will try my best to share my view on your question. So friends who have joined from YouTube, they may feel free to share their question in the comment section of YouTube, and I would read that question in the comment section and share my reply. Okay, so now let me start my presentation. I trust my screen is visible. I trust my screen is visible. Thank you, Tin. Thank you, Virendraji. It's good to see you, to find that Virendraji, you have joined, and we are meeting after extremely long time. Yeah. So, okay. We'll start with examples. I think I forgot to update the index. We'll start with examples. What there are, certain examples which are common. So let's see how we generally see intragroup transactions, how we generally find intragroup transactions. So the one example could be, let's say we have parent company in Japan and we have subsidiary company in India. And let's say subsidiary company is providing marketing support services to parent company. This is one example, and it could be let's say marketing support company. It could be software development services. It could be R&D activity. So it could be any activity, let's say, which is provided by one group company to another group company. In the other example, let's say it could be we have, let's say, two group companies. One is based out of Germany and another is based out of India. And let's say India gets some project. It's a global engineering group, and there could be more group companies in this group. Let's say India got the project, and for carrying out the project, it took some assistance from the German company, that is Group 1 company. So let's say Group 1 company is providing project management services to Group Company 2, which is in India, on project PO 100, that is project 100. So there could be another example. Let's say we have 4 group companies in a group, and we could have more group companies, but in this example we have 4. So 1, 2, 3, 4, 1, 2, 3, and 4. Let's say group company 4 is providing services to various group companies, maybe in the same city, or maybe in the same country, or maybe in the different countries. So if you see the example, the first 2 examples are more of a direct services, whereas example 3 is more on a common service. So, there could be more examples of, services. Let's say You are receiving on-call advisory or on-call support from your parent company or from your group company. There may be, let's say, management support, which is there in this example also. There could be R&D support, there could be IT support, there could be HR services, there could be some specific service, let's say engineering design for some project. So there could be n number of services which may flow from one group company to another group company. So broadly, we can classify our services in these four categories. One could be, let's say, the specific service, which is performed for specific entity for a specific need. So our first two examples were on the specific service, that the one company is providing management, is providing project supervision services to another company. In the first example, we saw that the Indian company was providing marketing support service to its parent company. Again, the example of specific service. Specific service arises because of specific need, and you can find, you can correlate the need and the service. So it is not one to many. It is generally one to one. So it may do happen that let's say you have service center in India, and that service center is providing specific services based on the requirement to different group companies. So for example, let's say a particular software is required by US company. So the Indian company is developing software for US company, whereas the need, let's say in the European region is different, and the software developed for European region is different. So there could be, specific, there could be one entity, which has got expertise, and that entity is providing need-based specific services to the group company. The another set of services could be common or centralized services, wherein, let's say, which are generally the known core activities, sort of support functions, management support functions. So there is one group entity which is, providing, let's say, the HR support services to various group companies. Maybe, let's say, the IT support services to various group companies, maybe the accounting support services to various group companies, or maybe, let's say, we have the group has centralized, the procurement function in one entity, and that entity is doing procurement for the group. Or we may see that, we have a dedicated team sitting out of maybe some location which is doing engineering design work for the group. The third set of activity may be the shareholder services. Shareholder services are generally performed because of the interest of the shareholder. So let's say the group may, for example, let's say the group is listed in US, and for the exchange purpose, the group needs to consolidate financials based on the US GAAP. And there are group companies in different part of the world, maybe, let's say, the Europe, maybe UAE, India, South Africa, and all of them were following a GAAP accounting standards, which are slightly different from US. And in order to merge the balance sheet, in order to merge the financials, US has got a team, let's say, which is based out of Singapore, that is collating all the data, merging the financials, and, I would request all of you to kindly put yourself on a mute mode. they are merging the financials and uploading it on the US on the exchange. So this the cost of conversion from other accounting standards to US GAAP is for the purpose of the shareholder. So this service is called the shareholder service. So the service which benefits the shareholder and not the group companies are generally or is generally referred as shareholder activity or shareholder service. Then the another type of service one may say is a duplicate service. That is, let's say, I'm already receiving a particular service from my staff, which is in-house service. I have got a relevant team to carry out those services, but I am receiving the same service from another group company. So this may be regarded as duplicate service. So the treatment for all four of them would be different, or the approach to all four of them would be different. Generally, it is said that specific and common services are chargeable service. That if you are receiving some specific service, or if one group company is receiving specific service from another group company, then one can pay the arm's length remuneration for specific service. Similarly, for common or centralized service. So if there is an inflow of common or centralized service, then one must remunerate the other entity on an arm's length basis. Whereas as far as shareholder and duplicate services are concerned, these are not to be paid. So if one entity is receiving a shareholder service, then as per OECD guidelines and as per commonly followed principle, the recipient entity is not receiving any benefit, and the purpose of the service is to benefit the shareholder. So generally, the charge for shareholder services is not allowed. Same thing for the duplicate service. That if there is a duplicate service which fails the benefit test, then again the charge for duplicate service is not allowed. Generally, one may not find too much duplicate services, until and unless it is required. So if in your case you feel this is a duplicate service which your group company is receiving, or which your associated enterprise is giving to you, based on my practical experience, I can say there must be some reason to it. For example, let's say being we are discussing tax, so we can take example from tax. Let's say the during the tax audit by the tax authorities, the tax authorities have prescribed certain tax additions, and they have raised tax bill on the client, so on the taxpayer. So taxpayer can go to both. Let's say he comes to you and he comes to me. He is looking for before moving ahead, he wants to be sure whether the approach which is suggested by Gaurav and which is suggested by another tax professional is in line or not, or where the matter is risky. Maybe in some legal matter you may take double opinion. So does it mean that it is duplicate service? The answer is no, because still those the objectivity of the service is to give benefit or is to give comfort to the service recipient. So wherein apparently you feel it is a duplicate service, my earnest request is kindly try to understand it more, because generally group does not, from a group perspective, if you see, incurring double cost for same activity is generally a group loss. So if I have already have a team in India and I'm receiving some services from Germany, why to pay twice? So from a group angle, group would not be interested to incur same cost twice. So there must be some logic. So I think that one can check. But as far as shareholder services are concerned, though OECD and UN and tax authorities are very clear that shareholder cost should not be charged, it is not allowed to be paid, but still, again, based on my practical experience, I have seen that still, these costs are charged as a part of a common cost. So when you are dealing with common services, one may go more in detail and check whether this common service includes shareholder service or not. So we'll have more discussion. I think any questions till now, any point which you want me to clear or discuss again? You may share your question in a chat box or feel free to raise your hand. Okay, I think there is no question for me. So let me proceed. So now how to deal when it comes to transfer pricing. So OECD guidelines provide some guidance and very important. And the guidance provided by OECD and you are pretty much in the same line. So we have a dedicated chapter in OECD which is chapter 7. And the very first para of the chapter says, this chapter discusses issues that arise in determining for transfer pricing purposes whether services have been provided by one member of an M&E group to the other member of that group, and if so, in establishing arm's length price for those intra-group services. So apparently you can see, it's a two-step approach. The first step is to determine whether the services have been provided or not. And if the answer is yes, then we go on to establish an arm's length price for such services. What UN has to say on this, you have a dedicated chapter on service in UN transfer pricing guideline, and which is chapter number 5. It says this chapter considers the transfer prices for intra-group services within an M&E, that is multinational enterprises. Firstly, it considers the test for determining whether chargeable services have been provided by one or more members of an M&E to one or more associated enterprises for transfer pricing purposes. Secondly, if chargeable intragroup services have been provided, it considers the method for determining arm's length consideration for the services. So if you see, both OECD and UN first talk about whether services have been provided, whether chargeable services have been provided. We can read it as same, that whether the services which have been provided are chargeable or not. Second, if yes, what is the arm's length price? So first we need to determine whether from a transfer pricing perspective, can we say that yes, one associated enterprise has provided services to another associated enterprise from transfer pricing perspective? If the answer is yes, the next stage would be to determine arm's length price. So this is a two-step approach. So when you're working on transfer pricing documentation, transfer pricing study, planning, or a health check, as far as intra-group services are concerned, it will always start with step 1. First, we need to understand and document whether it would be right to say that these are chargeable services. And if yes, then we'll move on to step 2, that is determining the arm's length price. So we're going to have discussion both on step 1 and step 2. So let's start with step 1, chargeable service. Under chargeable service, we're going to have discussion on benefit test, shareholder activities, duplication, incidental benefits, centralized services, one may say the common services, and also low value adding services. So we are on benefit test, and let's see what UN has to say on benefit test. Para 5.2.2.1, it says the benefit test is used to determine whether a member of the MNE has received a chargeable service from an associated enterprise. The benefit test has two requirements, both of which must be satisfied. Firstly, it must be anticipated that the activity will provide the service recipient with economic or commercial value to enhance or maintain its business position. Secondly, it must be shown that an independent entity in the same or similar circumstances as the service recipient would have been prepared to pay for the services or perform the services itself. In a nutshell, the benefit test basically asks you that whether the service recipient and not the provider, whether the service recipient is in this need of the service or not. Need may not be the immediate need. It may be, let's say, the company wants to start some project, maybe a technology product, which it feels that maybe after 2 to 3 years down the line, this product may have a lot of value or may have a lot of market. But before setting up of a factory or a manufacturing unit, they engage their group company for carrying out the market analysis, whether the customers are actually looking for this kind of technology over the period of 2 to 3 years down the line. So the benefit of this may not be immediate, or the need of this may not be immediate, and I need to set up factory maybe after 3 years or 4 years, maybe after 2 years, and still, let's say, I'm not certain. But still, yes, this justifies the need. I need to validate my decision, so there is no harm. There may be a case also, let's say you are receiving a service, but you may not receive the monetary benefit. For example, let's say you have hired a tax lawyer, but it is not sure that the order will come in your favor. Similarly, you have engaged your company, group company, in developing a software, but when you start using that software, you feel it is not of much use. Somehow this software is not adding value to your business. But when you contacted your AE, or when you contracted your AE for developing a software, at that time, you were of the view that yes, this software will going to support you. So as far as benefit test is concerned, if you see this the two requirement, that it must be anticipated that the activity will provide the service recipient with economic or commercial value. So it becomes very important to understand why your client or why the taxpayer is receiving the service. So maybe, let's say, if you are doing a tax function within an organization, or if you are a tax consultant or a transfer pricing consultant to your client, you may not have all the answers. So basically, you need to talk to that relevant department. Maybe the HR, maybe the legal team, maybe the IT team, whosoever is getting that service is consumed. So you need to talk to the functional head and functional team members to understand what is the need. And if you are able to document this, I think then you are done with your benefit test. The underlying notion of the benefit test is that in order to be chargeable, the service must provide or expected to provide the recipient within a commercial value to enhance his actual or expected commercial position in an identifiable way. So, for example, let's say you all are attending this webinar or this online discussion, and you are attending this with an expectation that you would get some value add by investing your 1 hour or 1.5 hour, correct? It may happen that at the end of the session, you may feel that it was not worth it. But why you are attending? It's because of the expectation, correct? And some of you may feel, the session was extremely good. But the question comes, why you are attending? You are expecting. The result may or may not match your expectation. So what you need to document is the expectation. As you know, sometimes we get a question from tax authorities to measure it in terms of amount or value. I think that is pretty tough to measure the benefit in terms of value. And if it is tough for us, for transfer pricing professionals, or for a transfer pricing team within the organization, it would going to be equally tough for tax authorities. So my suggestion is, and what I do practically, I focus more on documenting the need and the anticipation or the expectation. Instead of focusing on the value, because value is pretty tough. The benefit would be $1,000 or it would be $10,000 million. I think that is pretty tough. But why I took services, and how these services are adding value to my operations, I think that is more important, and that should be the focus area. Speaking practically. Whether or not, UN further says in para 5.2.4, whether or not the benefit test is satisfied does not depend on the level of risk that the expected benefit will or will not be achieved. This is what we are discussing. We may find the similar stuff in OECD guidelines, para 7.6, which says, under the arm's length principle, the question whether an intra-group services has been rendered when an activity is performed for one or more group members by another group member should depend on whether the activity provides a respective group member with economic or commercial value to enhance or maintain its business position. This can be determined by considering whether an independent enterprise in comparable circumstances would have been willing to pay for the activity if performed for it an independent enterprise, or would have performed the activity in-house for itself. So, this second para is extremely important. It says, if you actually need these services, what you will do? You will either going to hire a person in-house to carry out the activity, or you will going to outsource it, or you will going to subcontract it to someone, maybe outside the organization. So it defines the need, the requirement, that either I need to hire someone within my organization, or I need to outsource, or I need to get it done from outside. If that need is not defined, then the services are not rendered. In terms of value, as I said earlier, it would be tough. So the focus should be why. If the activity is not one for which the independent enterprise would have been willing to pay or perform for itself, the activity originally should not be considered as intra-group services under the arm's length principle. So if the answer is no, that I do not need this activity, or for this activity I will not hire someone and hire someone within the organization or give it to some third party, then the understanding is clear that you do not need this service. And if you do not need this service, you will not going to pay for it. If you're not going to pay for it, then it is not a chargeable service, and one should avoid. Then which simply means it may create problem during transfer pricing audit. But the only hitch is, or the only problem is, if you are dealing with the accounting team, without discussing with the functional head, your answer, you'll always going to get an answer that yes, we are in need of this service, we are in need of this service. But I think the precise answer you will going to get from functional head. So what supporting documents you can have to prove that you are in receipt of service? One can start with intercompany agreement. If there are exchanges of emails, you can have emails in your file. Then one may have PowerPoint presentations, reports, whatever your entity shared. So for example, we are discussing this and we have PPT, and I would be emailing PPT to all the registered participants who all were involved in provision of services, employees of the other organization, their names, email IDs, qualification, all that stuff can be documented. Need, I have already discussed. So if you are able to create a file, which has got all these documents, probably, you are on a right track to justify the benefit or to satisfy the benefit test for intragroup services. If you have any questions for me on benefit test, feel free to ask. So let me stop for a moment. You may raise your hand or you may type the question in the chat box. I think again, no questions for me. Is it overhead transmission which is happening? Can someone share the feedback till now, whether the session is going good or not, whether you are able to understand what I'm saying, it is making sense or not? Okay, Shweta is saying it's proper. All good. So whether, whether we are able to qualify the benefit test or not, let me ask in the transcribing sense, whether, we are already 40 minutes, we have already invested 40 minutes. So whether we are able to satisfy benefit test or not. It seems, yes, benefit test is satisfied. Any other answer? Whether we are able to satisfy the benefit test or not? Okay, I think, thank you everyone, receiving direct messages as well. Okay, now let me proceed. Now, the second set of transactions are shareholder services. We discussed these services in brief at the beginning of the session. Now, para 5.2.6.2 of UNTP guidelines says shareholder activities are activities undertaken to provide an economic benefit only to the shareholder company, ultimate parent company, or any other shareholder, such as an intermediary holding company, depending on the facts of the case in its capacity as shareholder. Accordingly, the cost of shareholder activities should be borne exclusively by the shareholder. Shareholder activities performed by an associated enterprise on behalf of its parent company should be charged to the parent company on an arm's length basis. So it's pretty simple. If you are receiving some services, question comes whether it is chargeable or not. And chargeability we are seeing from the perspective of benefit or need. As far as shareholder services are concerned, we do not need shareholder service. Shareholder service is going to benefit only the shareholders. So basically, the test is if I would have not been the part of a particular group, whether I have gone for the service. I'm not talking about alternative positions available. For example, I may be using X accounting software and the group is using Y accounting software. And now the groups take a call that let's move on from X to Y accounting software, and we have moved on to Y. So anyhow, I would be needing accounting software instead of X, and we have now Y. That makes sense, So it cannot be regarded as shareholder services. But we took an example of consolidation, of converting the books prepared in the local via local accounting gap to the US gap, something which will solely going to benefit the shareholder. So that would be regarded as shareholder services, and one should not pay for the shareholder services. What OECD says, a more complex analysis is necessary wherein associated enterprises undertakes activities that relate to more than one member of the group. So it's basically talking about the common activities, which we discussed earlier, that one may see shareholder services in the common activities. In a narrow range of such cases, an intra-group activity may be performed relating to group members, even though those group members do not need the activity. Such an activity would be one that group members perform solely because of his ownership interest. So whenever you see any charge, any common cost, management charge, or a common charge which is coming, I think that is something which needs focus. And one must understand various cost components and whether any cost component pertains to the shareholder service. And if yes, the same needs to be removed, because in an arm's length scenario, you will not pay for the shareholder activity which is not benefiting you. There are a few examples given in the UN transfer pricing guidelines and OECD type transfer pricing guidelines. One is the preparation and filing of reports required to meet the jurisdictional structure of the parent company, the appointment and remuneration of parent company directors, cost relating to jurisdictional structure of the parent company itself, such as meeting of shareholders of the parent, issuing of shares in the parent company, stock exchange listing of the parent company, and cost of the supervisory board, cost relating to reporting requirements of the parent company, including the consolidation of reports, the meeting of the parent company's board of directors and of the parent's company shareholders, cost relating to parent's company's audit of the subsidiary accounts carried out exclusively in the interest of parent company, and cost relating to the preparation of consolidated financial statements of the M&E, the parent company's preparation and filing of consolidated financial reports for regulatory purposes and tax returns, cost relating to compliances of the parent company with relevant tax laws. So basically, if any cost which has been incurred for the parent company, then it may fall within the purview of shareholder services. So again, we have a few more examples. The cost of raising funds the activities of the parent company to protect its capital investment in the subsidiary companies. So any question on shareholder services? Any question for me on shareholder service? Okay, let me proceed.
So Gaurav, may I?
Yes, sir.
Just tell me one thing. Means like we have got a global structure. We have got subsidiaries in overseas countries, wherein means our CEO, CFO, global CEO, global CFO, global head taxation, global treasury head. They go, they provide them the board meeting. They go and attend board meeting. They provide them few services related to treasury, related to taxation, related to financial activities, consolidation of account, etc., etc. So whether you will classify them as a shareholder services and hence not subject to any charge from parent to overseas subsidiaries, or they are supposed to be charged? If yes, then what could be the cost? One thing. Then second thing, then suppose if we start charging, then means how to benchmark them and all other things. Where will you find these kind of activities? Comparable companies providing these kind of services. If you have time, you can answer to these questions. This is just my thought process, so that we can discuss about it. Otherwise, you can move on. No problem.
So benchmarking, I will talk later on. We can currently on the shareholder service, so we can discuss that. See, we'll take two examples, Virendraji. You referred many activities. Out of those two activities, let's say one activity is tax service and another activity is consolidation. If let's say under tax services, you are reviewing tax positions of your subsidiaries and guiding them on tax structuring, or how to handle the local tax issues, then it is a benefit to the subsidiary. It is not a shareholder service, in my view. But if you are checking tax position at the time of consolidation, then the consolidation benefit will go to the shareholder and not to the subsidiary. Such service which you are doing for consolidation, to my understanding, would be more in the nature of shareholder activity. So the consolidation services should not be charged. Whereas if it is a tax service which is giving direct benefit to the subsidiary or to the group companies, it can be charged. Similarly, if I talk about treasury, if the idea is to benefit subsidiary companies in managing their cash flows, the benefit is going to subsidiary, and thus it should not be regarded as shareholder services, and a valid charge can be made to group companies. So this was in brief. I hope I'm able to make my point.
Yeah, thanks, Gaurav. Thank you. Thanks. Makes sense. Yes.
Thank you, sir. So now we have one question in the chat box. Shweta is asking, Indian company is a subsidiary of foreign company based in US. They are in software development business and services. Foreign company had oral communication with Indian company that Indian company must render services to client of foreign company. Indirectly, software services are rendered by Indian company to clients of foreign company. What is your view in this transaction? Is it taxable in India and TP is applicable, or whether or other implications on it? Okay. So Shweta, I think one needs to see section 92B subsection 2, because this transaction is directly with the clients. And so the friends who are joining from outside India, in Indian law, we have a concept of deemed international transaction. When we say international transaction, it generally means transaction between two group companies, two associated enterprises, one being non-resident. So there could be a situation like this, wherein you are dealing with a company which is not your group company or company which is not your associated enterprises, but still the transaction may be regarded as deemed international transaction. So when it would be regarded as deemed international transaction, when, let's say, the terms and conditions of the transaction or the price, is agreed between my AE and my customer in this case, for example. So if the foreign company has only said that you can directly provide services to my clients and you can raise bill, and all the negotiations are happening directly between Indian company and those clients, and the terms or conditions are decided by the Indian company and those foreign clients, then in my view, it would not become deemed international transaction. But if, let's say, the terms and conditions are predetermined by the foreign company, or the price have been agreed between foreign company and the customer, and based on the same, I'm providing the services, the Indian company is providing the services, then certainly it will fall under deemed international transaction under section 92B subsection 2. There is another set of service which is getting provided as the service of identification of customer or marketing by foreign company to the Indian company, because the foreign company is also referring customers to the Indian company. So that is also a set of service, Shweta, to best of my mind, which needs benchmarking. But as far as India is concerned, we have section 92 subsection 3, which restricts the applicability of arm's length principle or arm's length, the transfer pricing provisions, if the application of arm's length principle will result in increase in expense or decrease in income. And if in your case you are not paying, currently, let's say your entity is not paying any remuneration to the foreign company, but let's say as per the arm's length standard, it should have been paid. But then it would mean reducing taxable profit in India. And thus section 92 subsection 3 will come into the picture, and the TP provisions would not be applicable. I hope, Shweta, I'm clear on your question. Shweta, am I clear on your question? Thanks. Is there any question for me, or should I proceed? Okay, it seems I can proceed. I do not have further question. Thank you. Thank you, Shweta. Thank you, Virendra ji. So we have one more question. No, Virendra ji is saying. We have one question from Virendra ji saying, question: if Indian subsidiary appoints tax consultant, statutory auditor at the direction of its foreign holding company, parent company, whether oral or via email, and such Indian companies pays fees to such professional in India, which is also directionally influenced by foreign parent company, then are such engagements also a TP transaction? Sir, as I said earlier, if the only direction is that you should appoint XYZ company as your auditor, or globally we need to have XYZ as our tax consultants, in such a case, it would not fall within the ambit of 92B2, because the only direction is, that this should be the service provider. But what should be the fee? What are the terms and conditions? It is happening based on the negotiation between Indian company and that service provider. So there is no control, there is no participation in the control, management, or capital technically. Thus, this transaction would going to be an independent transaction and would not be regarded deemed international transaction under section 92B2. But as I said earlier, let's say if the foreign company or the parent company dictates not only the consultant, but also the fees that should be paid to the consultant and the terms and condition, then certainly it would become a deemed international transaction, which needs to be reported. So section 92B2, even if the transaction is happening between two residents, then also section 92B2 gets attracted because your associated enterprise is non-resident. So the condition is that the party with whom you have entered into a transaction or the AE, one of them at least should be non-resident. So it will fall within the ambit of the TP because the A is non-resident. Am I clear, Virendraji?
Now, Gaurav, one more clarification.
Yeah.
Suppose there is a umbrella agreement, means suppose that there is a software available in market and which is required by all the companies spread across globe, and means we negotiate from a central location, say my head office, which is based out of India. Then means we negotiate, we enter into an umbrella agreement, and then basis that there is some benefit which is there in the negotiation. So how do you think these kind of services from head office to subsidiary, whether means they what will happen means once an umbrella agreement is entered into, then basis that there will be sub agreement between amongst all the entities. They will enter into separately and they will pay separately for their fees. Whatever the software license fee is there, they will pay separately. Each entity is going to pay separately. So whether do you think that this kind of thing, this kind of services are also subject to some charge?
So there are two services, two transactions which are happening in your case. First set of transaction I will say is the centralized service, which I'm going to cover it shortly, which is like a procurement. You are acting as a procurement agent or sort of negotiating on behalf of group. So this service will going to benefit various group entities. So to best of my mind, it satisfied the benefit test and it becomes the service for which charge should be raised. Second set of transaction would be under Indian transfer pricing law. Because now you have negotiated the rates, you have set various terms, and now the transaction is happening between let's say the Indian company and that foreign vendor based on the terms and conditions agreed by the foreign AE. It will also fall under 92B2 deemed international transaction, and the same needs to be reported in the transfer pricing compliance. Am I clear, sir?
No, you are saying that means the transaction, the negotiation which the head office entered into, that will be that is a transaction between the head office and the service provider independently. Basis that these cost of services, say it was $100, it has been reduced to $98 because it is a bulk kind of thing. And then there is an umbrella agreement wherein broad terms and conditions of the service provider and the head office and all related companies are entered into. So in such a situation, these kind of this is a reportable services in the head office transfer pricing report.
So let me take an example. Let's say the one who is negotiating, let's say, is based out of India. Correct. So the first transaction is that that entity is negotiating on behalf of the group. So certainly it is providing a service, because this service will going to benefit to the entire group. Now, if I see from the perspective of the company which is based out of India, which is doing the negotiation, let's say that company is headquartered in Singapore. That entity which is negotiating on behalf of group is headquartered in Singapore. Then Singapore tax authority may say that it is a chargeable service for which you should have raised invoice at arm's length price on various group companies. That may happen. Now, second set of transaction is based on the negotiation done by a group company or associated enterprise, which is based out of Singapore. The Indian company has entered into an agreement with the vendor, with the independent vendor, and bought some software. That vendor may be based out of India or outside India. And the rates and everything was agreed between the Singapore and that vendor. Then certainly this transaction will fall within the ambit of 92B2, and this transaction needs to be reported in Indian Form 3CEB. So the negotiation done by Singapore company, the Singapore tax authorities may say that you should have raised the invoice. But as far as Indian tax authorities are concerned, they may they would like you to report 92 this transaction with the vendor under section 92B2. So let me share 92B2 with you. I trust my screen is visible. So my screen is visible?
Yes.
We can read 92B2. It says a transaction entered into by an enterprise, let's say the Indian entity, with a person other than an A, let's say that software vendor, shall for the purpose of subsection 1 be deemed to be an international transaction entered into between two A's if there exists a prior agreement in relation to the relevant transaction between such other person, that is the software vendor, and the associated enterprise, that is the Singapore headquartered company, or the terms of the relevant transaction are determined in substance between such other person, that is the software vendor, and the A, which is Singapore company, where the enterprise or A or both of them are non-resident, irrespective of whether such other person is non-resident or not. So am I clear, sir?
Yes. Yeah, thanks, Gaurav.
Thank you. So any other question on this, or shall I proceed? Okay. We have one more question from participant Yatin. Yatin is saying, asking, if an Indian company receives subsidy from government for setting up and operating of software development unit in India, and part of such services from this Indian company are also provided to foreign company, foreign AE, would this be covered under TP provision if the amount, sorry, I lost the chat, if the amount charged is same as from local clients, that is subsidized price? Basically, the subsidy benefit is getting passed on to foreign AE. So Yatin, see whether that subsidy benefit is on the entire sales or that subsidy benefit is for the domestic sales. If the subsidy benefit is limited to the domestic sale, then you cannot compare the domestic price with the export price. But let's say if the subsidy is both for exports and for domestic sales, then to best of my mind, there is no harm in passing on the subsidized subsidy or the benefit of subsidized price to A. See, at the end of the day, it would depends upon whether it can qualify as an arm's length price or not. And practically, let's say foreign vendor is aware that your government will going to give you, refund you some taxes, or they will going to give you some benefits. then he would like to negotiate with you. Further, if there are more companies in the same market, somewhere, it would going to lead to price war. And in order to be more competitive, the one would like to share the subsidy or pass on the subsidy benefit to the foreign customers. And that is the objective of subsidy, to make Indian companies more competitive in the international market. So I do not foresee any issue, but yes, it's very effect specific. So what is the objective of subsidy? Whether in an independent scenario, the other companies would be able to pass on the subsidy benefit or not is something to be seen. I hope I am able to answer your question, Yatan. Thank you. Friends, now it's time to proceed. We may take more questions later on. So now we are on duplicate services. We have discussed shareholder services. What UN has to say on this? (5.2.6.8). Duplicate activities are usually not chargeable services. The determination of duplication must be made on case-by-case basis. So apparently, things may look like duplicate, but it may not be duplicate. It was indeed the services which was needed. For example, Virendraji just discussed that you have a tax head or global tax or global CFO kind of a thing. So it is not, we may have a local tax head, but we may have a local tax managers also, but the perspective which group tax head can provide, that perspective may not be available with the local tax head. So it may not be a duplicate service. Rather, the local company may need support of the global tax head because he has got more experience, and there may be certain issues, maybe let's say to the global taxation, on which the global tax head may be able to provide some view, or maybe the similar situations might have arisen in some another country to which local tax head may not be aware, but the global tax head is aware. So apparently it may look like duplicate services, but practically it may not. So that's why one needs to see the application of this principle on case-by-case basis. There are some circumstances in which duplication may provide an associated enterprise with a benefit if an independent party would have been willing to pay for duplicated services in similar circumstances. For example, the situation may arise if an associated enterprise receives in-house accounting advice on an issue, but choose to get a second opinion to minimize the risk of being penalized for failing to comply with accounting standards. What OECD has to say, I think the same stuff, same logic, OECD also shares. In general, no intergroup services should be found for activities undertaken by one group member that merely duplicate a service that other group member is performing for itself, that is being performed for such other group member by a third party. And exceptions may be where the duplication service is only temporary, for example. So OECD basically says generally the duplicate service should not be there in the group because nobody would like to reduce the profit. If it is there, it may be of temporary in nature and that should be allowed. So this is what I said earlier, that one may not find duplicate services. That is not logical from a business perspective, that group businesses incurring one cost twice. That should not happen. There should be some logic, and if you're not able to find a logic, then only one should go ahead and report the duplicate service. Then we are on incidental benefits. I would be sharing my presentation. As I said earlier, we are on incidental benefits, and as far as incidental benefits are concerned, both OECD and UN says that for incidental benefits, one should not pay. So if I'm receiving certain incidental benefits, because I'm part of the group. Yeah, because let's say the one entity provided services to another. In such a case, one will not pay in an arm's length scenario. So for incidental benefits, one should not pay to the group companies. Centralized services, it's like common services we can discuss. Para 7.14, other activities that may relate to group as a whole are those centralized in the parent company or one or more group service centers such as regional headquarter company, and made available to the group or multiple members thereof. The activities that are centralized depend on the kind of business and on the organized structure of the group. But in general, they may include administrative services such as planning, coordination, budgetary control, financial advice, accounting, auditing, legal, factoring, computerized services, financial services such as supervision of cash flows, insolvency, capital increase. So, n number of services. The only one very important point is whether this centralized service or common service, is there any shareholder activity or shareholder service? That is something one needs to watch and review. Then we have another set of service, LVA, low value adding services. So these are those category of service which are non-core in nature, which is not the core function of the business, which is not adding great value, very basic kind of a service, non-core service. And so many tax authorities and taxpayers felt that it is sometimes becomes tough to benchmark this low value adding intragroup services. So the OECD and various countries, they have come up with sort of safe harbor or relaxed transfer pricing compliance for LVA for low value adding intragroup services. So if the activity is chargeable and if it is non-core and falling within the purview of low value adding, in such a case, one may simply remunerate the service provider on a cost plus 5% basis. So let's see what low value adding is. OECD TP guidelines para 7.43 says the simplified approach recognizes that the arm's length price for a low value adding intragroup service is closely related to costs. Allocate the cost of providing each category of such services to those group companies which benefit from using those services, and then applies the same markup to all categories of services. So I may bundle all the services. I may have a service center which is providing LVA, low value adding services, to all the group companies. And then it may include, let's say, some support, HR support, maybe the accounting support. And, instead of bifurcating it in accounting and HR, I may raise one bill on per entity and with a common markup. So as per OECD, low value adding intragroup services for the purpose of simplified approach are services performed by one group, one member or more than one member of M&E group on behalf of one or more other group members, which are of supportive nature, are not part of the core business of the M&E. So let's say the group is into accounting services and you have a common team which is doing the accounting, then it will not become LVA. But in general, accounting is supportive in nature. In general, accounting is administrative in nature, not core business of the group. Then it may be regarded as low value adding. But if accounting is the main business of the group, then it would not be regarded as low value adding service. Are of supportive nature, are not part of the core business of the multinational group, that is not creating the profit earning activities or contributing to economically significant activities of the M&E group, do not require the use of unique and valuable intangibles, and not led to the creation of unique and valuable intangibles. So again, more sort of admin activities. do not involve the assumption or control of substantial or significant risk by the service provider, and do not give risk to the creation of significant risk for the service provider. So these are those routine, non-core, very basic level of activities which you have grouped or housed under one entity or maybe more than one entity, and those entities are providing services. So you may opt. It is on the elective basis. So one may opt for LVA, and if generally if you see the law regulation, the LVA should be recognized by both the entities, both the countries. So if let's say we are receiving services from Singapore, then India also needs to accept that it is LVA, then only it will become LVA, low value adding services. So if you have opted for LVA, that if you classify a particular set of services as low value adding, then not much documentation is required, no benchmarking needs to be done. One needs to have documents to prove that it is LVA. Detailed functional analysis may not be required. And then markup is already decided, which is 5%. So you need not carry out benchmarking exercise. But if you feel, 5% is too high and I need to charge low margin, it is not LVA, and you are not opting for LVA, then maybe you may go for a exhaustive benchmarking exercise and prove your point. So UN gives few examples for low value adding intragroup services. One is the human resource services, accounting services, clerical or administrative services, tax compliance services, and data processing services. See, tax compliance is okay, but tax structuring or tax advisory will not fall under low value adding. Then they say these services, the following service are examples of services that would typically will not fall or fail to qualify as low value adding services. Services connected with main business functions performed by a multinational enterprise, extraction and exploration services, manufacturing services, construction services, financial services, because all these services generally add value to the business. Research and development services, marketing and distribution services, because they're directly related to sales. Strategic management services, they generally will not fall under LVA. So we are done with classification of services. If you have any question for me with regard to classification of service, please feel free to raise your hand or share your query in a chat box. And then we'll move on to discuss the benchmarking of these services. Okay, let me proceed. It seems we do not have any question right now. Now, step 2 is, once we are sure that yes, the services provided or received is a chargeable service, then comes the computation of arm's length price. So in arm's length price, the service may follow, the service provider may follow direct charge or an indirect charge method. What are these? So let's say, if I'm receiving certain engineering design services from my group company and they are charging a rate on per design basis, sorry, or on a per hour basis, then it is a direct charge method. Wherein if it's a common cost coming through allocation, then it is indirect charge method. But as far as benchmarking is concerned, we have those 5 methods which we need to use and benchmark. First is CUP, comparable uncontrolled price. Then we have resale price. Then we have cost plus. Then we have profit split. Then we have transactional net margin method. We generally know that we have 2 sets of comparable, internal comparable, and external comparables. Certainly, internal comparables are better placed or over external comparables. So if you have internal comparables, nothing like it, use internal comparables or do evaluate whether the transactions which are internally available can be regarded as internal comparables or not. And if internal comparables are not available, one may go for external comparable. Not one may, then probably one needs to go for external comparable. Rather, I would suggest that even if you have internal comparable, there is no harm in analyzing the position under external comparables. You want to make it as a part of your transferring documentation or not could be a second question. But yes, how the position look like, if tax authorities go for external comparable, that can be evaluated. So the first method is CUP, comparable uncontrolled price. So if you are receiving or providing services to your group companies, first we will check whether the entity is providing the comparable service to some third party or not. From a recipient side, whether the entity is receiving comparable services from third party or not. If the answer is yes, one may have internal CUP. If the answer is no, then generally, it would become tough to apply the CUP, comparable and controlled price, because then rates may not be readily available in the public domain. We do have, databases which talks about the service agreements, but then I personally feel, terms and conditions are very specific. Timing is CUP, price is very sensitive, so if I'm entering into transaction today, the agreement which is there in the database may relates to previous year, or the timeline may not match my timeline, I think, then that may not be of good quality. So to best of my mind, if you have internal comparables for CUP, nothing like it. If you want to rely upon external comparable, I think you need to be quite cautious. Resale price method is generally not preferred for service transactions, but yes, we have seen when there is a resale of service, and if internal data is available, one may use resale price method. Let's say if my role is to arrange the service provider and to get it connected to the customer, so I'm doing it, taking service from my AE, I'm taking services from my non-AEs and reselling the same to the customer. Maybe RPM can be used, but generally we have not seen resale price method in service transactions. Now, cost plus or TNMM are generally most widely used method after CUP. If one has got CUP data, nothing like it. If one does not have a CUP data, then cost plus and transaction net margin methods are used to benchmark. Again, you have two sides, service provider and service recipient. Ideally, we take we identify which party is the least complex out of the two entities, and that party is considered, to benchmark that party, that the margins of that party is generally benchmarked. As far as CPM is concerned, cost plus method is concerned, you take service provider, and if service provider is the least complex, you take service provider as the tested party and benchmark the markup on by the service provider. Again, I will say, if you have internal comparables, nothing like it. Let's say if you are an engineering company, or you have a project-based assignment, or you're a software company, then you may see the project profitability when you are doing the transaction with associated enterprises, or you're doing the transaction with non-associated enterprises. You may see the profitability at the gross level if the other functions are comparable, and you may use cost plus method. If you feel the functions are not comparable at the gross level, but they might get more comparable at the net level, one may prefer to use transaction net margin method over cost plus method. But let's say if internal data is not available, then one may go for an external data or external comparables. Again, the preference should be the preference should be to take service provider as the tested party. And whether CPM or TNM, that is cost plus or TNMM, transactional net margin method, whatever method you are using, if you're taking service provider as the tested party, one may look for a comparables in our databases which are comparable to the service provider, and then what is the profitability level. The same can be benchmarked if it is low or high, and accordingly the conclusion can be made, whether the transactions is at arm's length or not. But wherein you feel, the service provider is more complex and the availability of data may be a challenge, one may take service recipient as the tested party. But again, it depends, what is the level of, what is the percentage of expense paid to AE vis-a-vis non-AE. Let's say if my turnover is, for the sake of simplicity, let's say, 100 crores or 100 million, and my transaction with AE is barely 1%, then there is no point benchmarking the profits of the service recipient by taking service recipient as the tested party, because the transaction volume is pretty low. But let's say if the service received is 20-25% or maybe more, then maybe one may use service recipient as the tested party. But ideally, service provider should be considered as tested party while applying cost plus or transactional net margin method. Then we have a profit split method. When both the parties are assuming significant risk and contributing intangible, then you cannot remunerate to one party. I personally feel cost plus and TNMM operates more on the entities which are doing routine services, which are not contributing too much value to the transaction. But when you owns intangible, then the return should also be given on that intangible, and intangible will not form part of the cost. And not only the one entity, rather both the entities are contributing intangibles or taking risk, then in such a case, profit split seems to be more appropriate method in comparison to other methods. LVA, we have already discussed. The cost plus 5% is something which needs to be followed for LVA. I think I'm done with my presentation well on time. And if you have any questions for me on any aspect of intragroup services, maybe on benchmarking or other part of the intragroup services, feel free to raise your hand or share your query with me in a chat box. So we have a question from Okutokon. Can a taxpayer rely on the simplified approach of OECD transfer pricing guidelines, where the local TP regulation is silent on the approach to adopt? It depends, whether in general, local tax authorities are following the OECD approach or not. And if the precedent value or if the tax practice is such that local authorities are following, the OECD guidelines, then one may opt for the simplified approach. But I would advise, and based on the practices seen in other countries, generally for LVA, the country comes up with a specific regulation wherein it allows its taxpayer to use a safe harbor approach, which is named as low value adding service. So even if somebody wants to use, then it needs to be used with the cautious, because generally country allows specifically about LVA. Could you also elaborate about the safe harbor guideline rules? Are they binding on the regulatory authority? Virendraji, safe harbor rules are always elective. So unless you elect, unless you opt, they are not binding. But once you will opt, it would be binding both on taxpayer and tax authority. So unless you have opted for safe harbor rule, tax authorities cannot push you, or they cannot use safe harbor in their argument.
Thanks, Gaurav.
Any other question for me? Sorry, I do not know how to, I may be wrong in pronouncing your name. Emmanuel Okitukon. Am I clear on my answer? Okay. Any other question for me? Thank you. So if we guys are done with question, so let me say goodbye to all of you. Thanks for attending this discussion. I hope it was a value add for all of you. The discussion is available on my YouTube channel. I will share the link via email. You may watch it again on my YouTube channel. Thanks to all of you, and very happy Diwali to all of you in advance. Thank you.